Supermicro Computer just reported a $2 billion revenue miss. Operating cash flow collapsed to negative $6.6 billion in a single quarter, and the stock went up $5 after hours. Stay with me, because by the end of this video, you'll know, is this the most misunderstood AI infrastructure play on the market, or is the market about to learn an expensive lesson? They build the server racks that physically house AI chips. They are the unavoidable plumbing of the artificial intelligence boom. They command a massive 70 to 80% market share in direct liquid cooling and ship this hardware faster than anyone else in the industry. Now we have to look closely at this cash crisis. We're talking about negative $6.6 billion in operating cash flow, pushing them into $7.5 billion of net debt, while their inventory balloons to $11.1 billion. But here is exactly why that happened. Management stated that $2.7 billion in scheduled payments simply arrived a month late, moving from March into April, purely because the customer's data center sites were not physically ready for the installations. Is this a collapse or a $2.7 billion traffic jam? February delivered a monster second quarter earnings beat that completely shattered expectations and launched the stock upward. April brought a crushing rumor that Oracle had canceled a massive server contract due to severe delivery delays. May finalized the whiplash with a bizarre third-quarter paradox where top-line revenue completely missed guidance while underlying demand signals actually beat expectations. Look past the noise and you'll find genuine operational improvements that prove the business recovery is incredibly real. Non-GAAP gross margins recovered sharply from a dangerous 6.4% last quarter up to a much healthier 10.1% as expedited freight costs stabilized. On top of that, management is sitting on a historic $13 billion backlog, representing their largest pipeline ever. Hyperscalers are absolutely desperate for this liquid-cooled hardware, proving that market demand remains completely unbroken. And then Ernst Young resigned, stating they could no longer rely on management's financial representations. That brutal accounting shock was quickly followed by the Department of Justice unsealing a federal indictment against co-founder Wally Liaw for allegedly smuggling restricted AI technology to China. Prosecutors outline a multi-layered deception where millions of dollars in high-performance hardware were diverted to Chinese buyers using front companies and swapped serial numbers to bypass export controls. So now we're forced to watch two completely different realities trying to coexist. We have an engineering marvel capturing the vast majority of the liquid cooling market, operating alongside a company battling an existential crisis of institutional governance and federal law enforcement. You can see this exact duality mirrored perfectly in the current price action and the extreme analyst divergence. The stock is sitting near $27, severely beaten down inside its massive $19 to $62 historical range. This creates a glaring anomaly where Supermicro trades at a forward price-to-sales ratio of just 0.34, compared to a massive 3.17 industry average. Rosenblatt looks at this and issues a $32 buy rating on the fundamentals, while Goldman Sachs holds a firm $27 sell rating based strictly on the risk. They are looking at identical data but evaluating two completely different companies. The bull case argues their direct liquid cooling dominance gives them an absolute stranglehold on the mandatory thermal technology required for next-generation data centers. Their new data center building block solutions are aggressively targeting margins over 20%, introducing software-like profitability hidden inside a hardware company. Plus, their massive infrastructure pipeline for the highly anticipated Blackwell and Vera Rubin architectures is already locked in with desperate customers. They just delivered an astonishing 123% year-over-year revenue growth while trading at that incredibly compressed 0.34 sales multiple. If they can clear the legal noise, this is undeniably one of the cheapest AI infrastructure plays on the market. Gross margins have fallen for 3 straight years, from 15% down to 10%, because massive hyperscale customers will never stop squeezing their suppliers for lower pricing. Ernst Young did not quietly leave the account. They filed a highly public resignation explicitly stating they could not trust management's own financial numbers, which entirely destroys institutional credibility. The co-founder was indicted for orchestrating a scheme to smuggle restricted AI chips to China, and that is not a compliance footnote. That is a severe federal crime carrying massive penalties. A single unnamed customer accounts for 27% of total revenue and was responsible for the late payments that cratered cash flow, which is not business diversification, that is dangerous operational dependency. We've also tracked $80 million in insider selling by executives while the stock is down 57%, signaling a massive lack of internal confidence.
Finally, a May 26 class action lawsuit has shareholders alleging systemic fraud and material weaknesses in export compliance, threatening to tie the executive suite up in years of brutal litigation.
Looking ahead, we have 4 punchy future catalysts that will immediately dictate this stock's trajectory. First, if the May 26 lawsuit progresses to discovery, it will expose the true legal weight and financial penalties of these compliance failures. Second, if we get official confirmation in June regarding the Oracle contract, we'll instantly know if that critical business is permanently gone or simply delayed. Third, when the August fourth quarter earnings report drops, we'll find out if that delayed $2.7 billion customer payment actually arrived to repair the balance sheet. And finally, looking toward late 2026, if they want this stock to recover, we need concrete proof, not just promises, that those new building block solution margins actually hit that 20% threshold.
SMCI is either the infrastructure backbone of the AI era or a governance time bomb trading cheap for a reason. Will you buy the liquid-cooled monopoly right now at a massive discount, or are you staying completely away until the federal investigations conclude? I'm genuinely curious to see how this plays out, and I'll be keeping a close eye on the entire AI landscape for us. Hit like and subscribe so we can navigate these wild market swings together.